Good afternoon, everyone. I'm really sorry we had to delay the broadcast by 10 minutes due to some technical difficulties, but we'll be starting now. If you have any queries, we'll be posting a link in the description of the video for trading Q&A, wherein you will be able to ask all of your questions, right? So let's get started. Karthik will be starting now. All of your questions, right? So let's get started. Karthik will be starting now.
Hello, everyone. Thank you so much for taking time out to attend this webinar. My name is Karthik Rangappa, and I'm a part of Zerodha family. The focus for today's webinar is to throw some light on the cash flow statements and understand how the cash flow statement can actually help you while making an investment decision. When I say investment, when you're thinking of investing in a stock for a long-term basis, right? When you're probably building a portfolio. So, I mean, I would assume that you're fairly comfortable with understanding a cash flow statement. If you're not, then don't worry. We have this module on fundamental analysis. It starts from the basics and goes all the way up to conducting a DCF on a stock. DCF is when you want to get a perspective on the valuations of a company, right? So this got a ton of content, including the cash flow statements. For those of you who are not familiar with cash flow statements, I'll just try to, I'll attempt to give you a quick overview of what a cash flow statement is, right? So, of course, all the contents are there here in the chapter number 8. You can go through it in leisure, right? All right, so let me get to the main part. Okay. So any company that you take up, right? Any company on this planet, whatever activity that they do, it has to be classified under one of the three main categories, right? Categories of activity. That would be the operational activity, the investing activity, and the financing activity. So any activity that a company does has to fall under one of these categories. Operational activity is the core of the company, right? So let's assume there's a company which manufactures footwear. Now, manufactures and distributes and sells footwear. Now, the core operations of this company, as you can imagine, would be manufacturing, sourcing the raw material, manufacturing, the footwear, distributing it across the country, maybe running some promotional activity, advertisements, etc., and eventually selling the footwear. Now, this would be categorized as the core operations of the company, right? So all such activity, would be categorized as operational activity. Now, in order to manufacture footwear, the company has to have a manufacturing plant. That's a given, right? So it has to have a manufacturing plant. It needs to have a sourcing plant. It needs to have some sort of R&D, and there's some investment which goes into manufacturing these things. So all those investments which aid the operations of a company is called the investing activity. For example, this company could set up a leather tanning unit to tan the leather and give it some sort of color. So the act of investing in a unit, in a plant, in a machinery, is called the investing activity of a company. Now, if a company is, very profitable, they can fund most of their investing activity. But more often than not, companies resort to taking external borrowing. It could be from, by floating a bond, or it could be by, approaching a bank, right? So all the loans that they take out, a company will be continuously taking out loan, repaying loan, and paying out dividends, receiving dividends from whatever investment they've made. So all activity related to finance is categorized as financing activity. So I mean, end of the day, whatever that a company does is either an operating activity, is either a part of the operating activity, or a part of the investing activity, or a part of the financing activity. It has to be categorized as one of these things. Now, here's the beauty of these activities. Now, each activity either consumes money, or it produces money, it generates cash. For example, if this company is, let's say it's selling 10 million units of footwear, and it's making a certain profit out of it, then we tend to say that the operations are successful and the operation is generating a positive cash flow, right? So it's generating a positive cash flow. Now, investing activity, let's say I'm investing in a plant, I'm investing in a machinery. So money is going out of the company, and therefore we tend to say that investing activity is consuming cash. Now here's a situation where, let's say, a company is bought a machinery, it's kind of served its purpose, and the company wants to sell it off, right? So maybe there's another small company which wants to buy this machinery. Now, in such a case, the asset which the company has invested in is being sold to another company. Now, the proceeds of the sale produces some amount of cash. Now, this is a situation where investing activity has produced cash, right? Likewise, in financing activity, let's say this company goes and approaches a bank to raise a certain amount of loan. Now, in this situation, cash is coming into the company in the form of loan. So we say financing activity is producing cash. Now, if the company is repaying money, repaying its loan, then we tend to say that, financing activity is giving out cash, or, so just giving out cash. So yeah, in summary, each of these three activity can either generate cash or consume cash. Now, here's a very, very important point that I want you to remember. Any company that you intend to invest in, always look at the cash flow from operations. Point number one, rule number one, this is the most important thing. The company has to produce money operationally. If it is unable to produce money operationally, then there's something wrong with the business model of the company. There is some lack of planning or efficiency, or maybe the product itself is not very good. So always double check whether the company is producing cash operationally, right? So yeah, I'll leave it at this. I think that hopefully that serves as a quick introduction to cash flow. Of course, if you go through this module, we've got a ton of content with examples and all that stuff. So I would strongly suggest that you go through this chapter, whenever possible, right? So yeah, so now what I plan to do is, I've lined up some cash flow statements of few companies here. Right, let me just zoom this in. I've lined up the cash flow statements of few companies, 5-6 companies, and I've got it from 2007 all the way up to the last financial year, that is 2016, right? So there's roughly 9 years worth of data. So my objective for today is this, so just by looking at, for example, this is the cash flow statement of JP Associates. Now, just by looking at these numbers, I want to I want to develop certain insights which will help me decide whether the stock is worth investing or not, right? So that's exactly what I want to do, and and convey through this webinar. Hopefully this is big enough and you can see the numbers. Anyway, so let's get started. We've got JP Associates as one of the companies here. Okay, JP Associates, if you're an old-time market guy like me, you would probably understand, you would probably know the kind of craze JP Associates had. Everybody wanted to trade JP Associate, everybody wanted to own JP Associates in their portfolio, right from a small retail guy to a big fund manager. Right, so it was a market darling, right? But look at JP Associates today. So I've loaded it on my portfolio. It's trading at 13 bucks. I think it went all the way lower, if I'm not wrong, 8 or 9 rupees sometime last year. It's back to 13 rupees, but still, I would consider this a penny stock, right? So that's JP Associates. What is it that happened in JP Associates, and why did the stock collapse like that? And would cash flow give us some sort of insight, right? That's the big question now. Let's look at the cash flow from operations. Operationally, the company has been generating decent amount of money all through these years. For example, 2007, it generated close to about 1,100 crores. 2008, it generated about 900 crores. 2009, about 700 crores. 2010, it took a beating. but looks like they bounced back in 2011, so on and so forth, right? So 2016, it looks fantastic. Nearly 6,500 crores of cash has been generated through operations for 2016 alone. On the face of it, it looks fantastic. Let's sum up all the cash flows, historical cash flows. So over the last, by the way, all these numbers are in rupee crores. So which means to say JP Associates over the last 9 years generated nearly 28,787 crores. I mean, that's a large amount of money and it looks fantastic, right? Great. Now, what did JP Associates do with so much money, right? So it generated so much money. Now, what did it exactly do with it? Let's look at the investing activity. The investing activity, the first thing that occurs to me is it's negative throughout, which means to say investing activity is consuming money. In other words, the company is investing in itself, maybe because it sees a brighter prospect, right? So it's been continuously investing in itself, except for 2016, because 2016, it's a positive number. Let's look at what that means in a short while. So let me sum up the investing part. Let's see how much they've invested. Look at this. JP Associates has invested close to 66,000 crores in itself, right? I've taken a net sum here. Now, all you have to do is, think about it this way. It has generated 28,000 crores in cash, but it has invested close to double of what it has earned in various sorts of projects and assets. Where did they get the money from? I mean, nearly double, right? So where did they really get the money from? So let's see what the financing activity reveals. First and foremost, financing activity, if you notice, is positive throughout, right? Almost way till up to 2015, it's a positive number, which means to say they continuously borrowed money. They borrowed to the extent of 37,000 crores. So all this money and a large portion of this money, that is money from operations, has gone into investing activity, right? So they've invested helter-skelter, and in the whole process, they've taken on a huge amount of debt, nearly 37,000 crores of debt. Now, here's a question for you, right? Now, if they have taken 37,275 crores of debt, even assuming a modest 10% interest rate on this debt, we are talking about a yearly interest payment of 3,727 crores. Think about it. Operationally, the company is generating, first of all, this is pretty volatile, right? 4, 3, and 6,000. Anyway, and operationally, they're generating a positive cash flow, but half of it is going out to repay banks and debt holders, right? Half of it is going out as just interest repayment. I'm not even talking about the principal repayment here, right? Now, if that is going out to debt holders, they also need to run their operations. And, what will the investors get? What will the investors get? They won't get anything, right? There won't be any returns. There is no case for investment here. Another crucial point, assume that they manage to repay interest from operations. How will they repay back the principal, or on what basis will they repay back the principal, right? Companies in this situation, more often than not, resort to clearing their principal by selling off assets, which is exactly what has happened in 2016. If you see, the number here is positive, which means to say that they're trying to sell their assets to clear off this debt, right? Now, if a company continuously starts liquidating its assets, then, it will obviously take a beating on its operations, and it will obviously take a beating on their operating income, and it has a trickle-down effect, and finally, investors are left with nothing, right? So this is a clear warning sign. I want you to appreciate that, we've not looked at any chart, any balance sheet or P&L. We just looked at these 3 lines, and we were able to generate a lot of insight. And based on this alone, if you were to ask me, would you invest in JP Associates? Definitely not, right? The company is clearly sitting on a time bomb. Yeah, so that's with JP Associates, right? So we will proceed to the next company. We've got IVRCL. IVRCL, as you may recognize, is another infrastructure play, right? So let's look at the cash flow from operations, again, starting from 2007. 2007, close to about 212 crores. 2008, minus 670 crores, which means to say they've lost money operationally. 2009, they've again lost money, but not as bad as 2008. 2010, minus 54, again they've lost money, but again not so bad as 2009. Big spurt in 2011, maybe they bounce back, right? So pretty volatile numbers. If personally, when I'm looking at cash flow from operations, whenever I see volatile operating activity numbers, it kind of puts me off. I don't even, it's not a very good thing. One of the main, things that I look for when investing in companies is that operationally the cash flow should be stable, or it should be trending either upwards or downwards. Some sort of trend should be there. Volatile numbers like this is a big no for me. Anyway, so let's sum up all their cash flows. Let's see how much money they've generated through operations over the years, right? So they seem to have generated, okay, so not generated, they've lost money. They've lost close to about 178 crores over the last 9 years. This to me is a big disaster, right? So over the last 9 years, operationally, the company has lost 178 crores, right? Bad. But let's see what they're doing in terms of investing activity. Their bad operations didn't deter them. Looks like, first of all, the numbers are all negative throughout, even 2016. So which means to say their bad operations didn't stop them from investing. They're investing further into their business. They've invested pretty large amounts of money all throughout the years. Let's see how much money they've invested. Look at that. They've invested close to about 7,848 crores, right? So they've invested pretty large amounts of money. Now, there is no way that this could have come from their operations. The investment could have, come in from their operations. Very clearly, it says that they have borrowed lots of money. Let's see to what extent. So if they've borrowed, that means to say the cash flow from financing activity has to be positive, which it is, right? So all through the years, they've borrowed money, maybe without any discretion, right? So let's just put this number. So that reveals the entire story. So nearly, I can round this off to 8,000 crores. I can round this off to 8,000 crores. So 8,000 crores of investment has been completely, funded by borrowings from banks and debt holders or bonds or whatever. But they've borrowed money to invest in their own business. Operationally, they are not capable of generating that kind of money. This is a clear sign of a leveraged balance sheet. If a balance sheet, we say a balance sheet is leveraged when there's too much debt on the balance sheet. Now, this is a classic example. Now, again, let's do the same drill. If they've taken this money, even at a modest 10% interest rate, we are talking about 812 crores of interest repayment every year. But operationally, they're just generating about 108 crores. Clearly not a good sign. So if you were to guess what is going to happen to this company over, let's say 1 or 2 years, they will eventually have to repay this large principal amount, which is 8,128 crores. Operationally, I don't think so. They will bounce back to an extent where they can repay this loan. They'll have to restructure their loans, or they will be forced to sell all the assets they have piled up over the years. This company, my punt is they will liquidate assets, right? They will liquidate assets and they will repay back their loans, right? Now, this is a situation a company should not really be in, and you as an investor should not be investing in such companies, right? So let's look at the stock price. Here is IVRCL Infra for you, $5, penny stock, right? Not worth investing in. So again, I want you to appreciate that we've not looked at anything else. We've just looked at just 3 lines of information, right? And it's revealing a whole lot of details for us. This is exactly why I love cash flows. Just 3 lines. You need not have to look at anything else. Just 3 lines of information gives you a ton of insights. Now, for example, if a company is producing cash flow from operations consistently, over the years, it not only tells that the company's products are selling, operationally it is profitable. It also tells us that, the management is efficient, right? So there are a lot of information that you can extract from just 3 lines of information, right? So now, would you be investing in this company? Please don't. I wouldn't. And I would advise you also not to, right? So that's IVRCL for you. I've got another company here called South Indian Paper Mills. Now, this is a small little company situated here in Karnataka in a place called Nanjangud. So what does South Indian Paper Mills do? They are in the business of manufacturing paper products. They manufacture the corrugated box that's usually associated with your Flipkart or Amazon delivery. Such kind of boxes these guys manufacture in large capacity, right? So let's look at their. I've obviously picked this for a certain reason. I'll tell you that very shortly. All right. So operations wise, starting from 2007, they've been generating 11 crores, 6 crores, 17 crores. Okay. So if I were to make a quick, estimate here, first of all, the cash flow from operations all the way up to 2015 has been positive, which means to say they are generating cash operationally and they're generating small amounts of cash, right? So that's important to note here. They're generating small amounts of cash. Small amount is not a problem as long as it's positive and as long as it's displaying certain amount of trend, right? But 2016, the cash flow nearly doubled, right? So that's a number to revisit. We will revisit. So the cash flow suddenly doubled, which is pretty interesting. Let's see what they're doing with the cash that they've generated, right? Are they investing? Yes, they have been investing all throughout. And looks like they're investing sums smaller than what they've earned. So if they've earned 11.5 crores here, they've invested about 5 crores in their business, right? And it looks like a recurring pattern here. They're continuously investing in their business, maybe expanding their capacity or improvising on their manufacturing technology or whatever. But the point here to note is they are investing a sum which is smaller than what they're generating. Now, this to me gives me some sort of, helps me develop some sort of opinion on the management style. Maybe they are pretty conservative in their approach, which is not a bad thing, right? In fact, it's a very good thing for an equity investor, right? Now, and look at the financing activity. This according to me is a beauty, right? So financing activity is continuously negative barring 2009, right? So which means to say that they want to repay back their debt, right? So from whatever money they're earning, a part of it is going towards investing in assets, investing in themselves, and a part of it is going towards repaying their debt. A brilliant combination if you were to ask me, right? But let's just focus on 2016 here. So all through, if I were to make a single line judgment here, I would say the management is extremely conservative and prudent with their financial management. But 2016 cash flow from operations doubled, right? Why would it have doubled? Maybe the business prospects have improved, right? And the management suddenly has invested a pretty large amount, with respect to their historical investments. They've invested nearly 44 crores of money in terms of, I don't know what sort of investments they would have made, but if I were to guess, maybe plant and machinery, expanding their capex and, upgrading their technology or whatever. But the point here to note is they've invested large amounts of money. And they've even gone out and borrowed a pretty large sum here. 12 crores, which is positive, tells me that they have borrowed a large sum, right? So let me just quickly sum up their cash flows. Right? So they've borrowed large amounts of money. Now, think about it. Why would this company do this? All throughout last 8 years, they've been very conservative, but 2016, there looks like there is a pretty aggressive stance from the management. Now, I would look at it as a turn around. Sorry, what happened? I would look at this as a turnaround situation. Maybe there's a turnaround situation here. Maybe the business prospects is improving. And that's the reason why the management has gone ahead and invested a large sum. They've even gone ahead and taken a debt. Now, debt in this background is very good to me, right? So this gives me a very comfortable feeling. This tells me that, this company has something going on, and I should be, this would trigger my, inquisitiveness, and I would dig further into the annual report and, look at what they're talking about, their business, look at the balance sheet, look at the P&L. This would lead me to take further action. While at the same time, these two stocks would not lead me to take further action. Straight away, just by looking at these three lines, IVRCL and JP Associates, I would run away from them. But South Indian Paper Mill looks like there's a turnaround situation, and I would be interested in exploring the stock further, right? So that's with South Indian Paper Mills, right? Right. So let's move to the next stock, TCS, fairly large company, right? So let's look at the cash flows here. All right. So look at the cash flows from operating activity. Positive numbers all throughout, right? 2007, they generated close to about 3,500 crores. Similar numbers in 2008, and now this is, if you ask me this, these are beautiful set of numbers, right? So first and foremost, the numbers are trending. So every year the company is generating not only positive cash flow, the numbers are also increasing year on year, right? So if I were to quickly calculate the CAGR of cash flow from operations, so that would be, let me just do that, so this divided by this, close brackets, raised to the power 1 by 9 minus 1, right? So 21%. So the company is generating money operationally at the rate of 21% year on year. These are beautiful set of numbers, right? And let's see how much money they've generated, over the years, right? Look at that, 98,795 crores. Now, for no reason, probably this is the reason why TCS is one of the most valuable company in India in terms of market cap. The company is, I think if I'm not wrong, worth close to about 5 lakh crore, right? So, yeah, and probably this is one of the reason why it commands such a beautiful premium. Right, so the company is generating positive cash flow, and it is also growing its cash flow at a very, very healthy CAGR. Now, what have they done with so much money? I mean, that's large amounts of money, right? So what have they done? Have they invested in themselves? Looks like. So 2007, they invested 1,800 crores, which is roughly half of what they earned. That has been deployed in, in their own business. Now, TCS is an IT company, right? So what sort of investments can they do? They'll need IT infrastructure, obviously. They'll need an office space. They will need, maybe some telecom equipment and stuff like that. But it's not a very, capex heavy business, right? So, and this is exactly what the investing activity numbers reveal to me. Initially, they invested, close to half over the initial years, they invested close to half what they earned in themselves. But over the years, that investing number has come down, right? So they've invested lesser and lesser amounts of money in their own business, right? So maybe another way to look at it is whatever they invested earlier on in the business is kind of paying out dividends now, right? So how much have they invested overall? They've invested close to about 40,000 crores, right? They've invested close to about 40,000 crores in their own business. Now, out of the 1 lakh crore that they've generated, 40,000 crores has been invested. Now, what happened to the balance money, which is roughly 60,000 crores, right? So we'll investigate that. Now, let us look at cash flow from financing activity. Cash flow from financing activity, the first thing that strikes to me is the numbers are negative throughout, right? It's a negative cash flow from financing activity. Usually, when I look at a negative number, what comes to my mind is maybe the company is repaying its debt. Now, TCS being an IT company, it's a well-known fact that they don't have, most of the IT companies don't have debt on their balance sheet. If they do not have debt on their balance sheet, what are they repaying, right? So continuously the numbers are negative, which means cash is going out. That means that they must be repaying something, but they do not have debt, right? Now this is a case where the company is paying out dividends, right? So whatever excess cash is there, they're paying that out as dividends. There is no debt. Cash flow is negative because there is a dividend payout. How much dividend have they paid out? There you go. Roughly about 52,000 crores of dividends TCS has distributed over the last 9 years, which to me again is fantastic. Now here's the thing with when you're managing the finances at a company level, right? So all the money that you earn, you either need to invest it back in your business. If you're unable to invest it, if you're not able to identify situations where you can invest that money profitably back in your business, you're better off giving that money to your investors as dividends, which is exactly what TCS has done. They've invested part of their money in their own business, and a bulk of the money has been given out as dividends. This according to me is a brilliant, corporate governance, brilliant management take, and this is exactly what the cash flow statements of TCS is revealing. If I were to invest just based on cash flow, I would go ahead and invest, right? But of course, there's a lot of other things happening with TCS. There's been a management change, and you need to study, you need to understand how the IT business works, and then take a call on whether to invest or not. But just the cash flow numbers, they are beautiful, if you were to ask me, right? Let's look at the last company. We've got Infosys here. Right, so let's do the same drill. Let's look at the cash flow from operations throughout. Again, they've grown cash flows beautifully. 2007, they were at 3,500 odd crores. 2016, they're at close to about 9,000 odd crores. Let's look at the CAGR. What rate have they grown their cash flow from operations? Let's see if it actually matches up to TCS, right? Okay. Not as much as TCS, but nevertheless, 12% growing your cash flow is not a not a bad thing. So, but of course, TCS was growing it at close to about 21%. These guys are growing it at 12%. Not bad. I would still be happy with such kind of growth, especially given the fact that Infosys is a very, very large company, right? So positive numbers throughout, highly profitable operations. Let's see how much money they've made, right? So they've made close to about Obviously not as much as TCS, but yes, now they've made about 65,000 crores in operations over the last 9 years, right? Which is fantastic. But this is not the point with Infosys. We need to find out what they're doing with this money. Are they investing in themselves? Yes, they are investing, but not much. They're not investing much here, right? So they've not as much as TCS. Let's sum up their overall investments around the same year. While TCS invested 39 crores, Infosys just invested 8,000 crores with in their own business, right? So out of 65,000 crores, 8,000 crores is being invested in their own business. What are they doing with the balance money, right? Look at the financing activity. Oh, not impressive at all. Obviously, no debt here. So this is dividend payout. But look at the amount of dividend Infosys has given out, right? So let's see how much dividend they've given out. Just 30,000 crores. I'll round this. Actually, I can't round this to 30. Let's say 29,000 crores. 8,000 out of the 65,000 crores, 8,000 is being invested with themselves. 29,000 crores has been invested, not invested, distributed as dividends. Where is the balance money sitting, and what is Infosys trying to do with this numbers, with this money, right? So that's the kind of question you need to be asking. So I looked up Infosys annual report and I looked at the cash flows, the cash statement, and here is where the balance money is sitting. Right, nearly 32,000 crores as of 2016 is sitting in deposits and financial institutions. Right, so this is an extract from the balance sheet, as from the annual report, and it clearly states that in current account and deposit accounts, 27,000 crores, which is the balance money, roughly the balance money here, that is sitting in a bank. Now, here's my, not just mine, but all Infosys investors have this crib with the company. If you're unable to invest in yourself, right, in your own business, and ideally you should be giving out that money as dividends. Now, Infosys is neither investing in businesses, nor is it giving out dividends. It's been holding cash, right? Now, that's not acceptable. And if you see, there have been a lot of open letters written by likes of Mohandas Pai and Nandan Nilekani and, all those stalwarts saying that, they're not managing their cash well. They need to give out dividends, right? Investors are better off utilizing that money. So, but that's not happening. So, yeah, so that's about it. If I were to take a, call on investing in TCS versus Infosys, just based on this assessment, my bet would be on TCS. Right, just on this observation. But of course, as I mentioned earlier, there are lots of other things that you need to look at. When you're trying to make a decision on whether to buy a stock or not. Cash flow is a great starting point. In fact, this is how I always look at my investment decisions. The first thing that I always do is look at what's happening in the cash flow. If you're aware, there is a balance sheet, there is P&L, and then there is cash flow. These three statements together form the financial statements of a company. From my perspective, cash flow is the most sacred. It gives you the real picture of how the company is managing its cash. And it also tells you a great deal about the management style, whether it's conservative. We looked at this company here. Just these numbers tells me a lot about the way the company is managing, their day-to-day activity and whether the company is conservative or not. So, yeah, so that's about it, guys. So I hope you found this webinar interesting. Please do take cues from this and follow up by reading up the content on Varsity. We've got great deal of stuff going on here, right? So the entire fundamental analysis is documented here with an example. Eventually, what you need to be doing is trying to find out the valuation of a company by doing a discounted cash flow analysis. We've taken up an example here and demonstrated how you can do a two-stage DCF. So yeah, so good luck, guys. Happy investing, and thanks again for taking out time and attending this webinar. So yeah, see you again soon. Bye.